chat, which is why are banks falling? And Lata's answered that the main issue here is inflation and these hardening yields, with the benchmark yield now expected to move to 7.25%. I just want to put some data, in context before we move to our next guest on this issue. Now, what is this fall looking like? The Nifty in this month is down 1.8%. The Bank Nifty is down 4%. So banks have been preempting the fall, so to speak. Not only is the Bank Nifty trading both below the 20 DMA and the 50 DMA, now it's very close to the 100 DMA. Where does the 100 DMA come in? It comes in at 43,571 thereabouts. Today's low was 43,600, so almost testing the 100 DMA and then bouncing from it. The bank index, the Nifty Bank, has lost 5.5% from its peak, which is a lot more than the Nifty, which is down about 3.5%. So very clear, banks have been falling. The question is why? Unmesh Sharma, head of institutional equities at HDFC Securities, is with us to answer that question and also talk about the overall market construct. Unmesh, good to have you on the show. So as Lata was explaining, clearly this last print is not making anybody more comfortable at all. If anything, we are probably, moving further away from any rate cut or any easing expectations. But you tell us, what have you made of the bank fall? And what else is contributing beyond maybe some of these macros?
So a couple of things. On the macro, I think I was just listening to what Lata is saying, so I have nothing really to add. Our bank's economist view is exactly the same, that the inflation number for the year, the forecast for the year for the RBI will go up. What that effectively means is that whether we get another rate hike or not, is that this whole stance of withdrawal or accommodation is something that will remain. And going into tightening, I think expecting any kind of rate cuts now in this scenario remains very, very tight. I think our core assumption is that we are not likely to see anything this fiscal. That's a long time away. It's like the end of March, right? So from that perspective, I think that it will remain challenged. This is also added by the global woes, which is the other part of the macro, right? Because if you see what's happened with the Fitch rating downgrade, it's not like it's surprised anyone. But what has happened is that it has brought focus on this whole issue of the fact that, there is a risk to the financial sector, right? So if you see what, first there was a downgrade of the sovereign, and then there is this whole news now the last few days that you could see major bank downgrades across the US. What that has effectively done is put us into a phase globally of risk aversion. Now, in that case, what happens is, and which is the second part of this problem, is that as you get risk averse, and then there are problems in China. So, as people withdraw money from the emerging market funds, what you will notice is that in India, if you look at what's happening with the FPI flows, is that over 80% of the flows comes from emerging market funds, and the rest is India dedicated. In that context, as there is a little bit of concern on the emerging market, the FPI selling over 10,000 crores has happened now in this recent fall. And a lot of that is dominated by the ETFs and the large caps, and then banks obviously dominating that. So from the macro perspective, on both counts, on inflation, which is what Lata was talking about, and then on the global risk aversion, banks seem to have come under pressure.
Okay, that, got that. But Unmesh, tell us, how do you expect things to move from here as well? In terms of the earnings that we got for the entire bank pack, I know, of course, the NIM compression is what we've all been talking about. How much longer do you expect that kind of the pain to, really last on the financials as well? And then how would you approach these banks right now, say from a one-year perspective?
Yeah, so look, the sweet spot for the banks was actually last year. Which was FY23, which is where once the rates start to go up, you get the asset side kind of repricing upwards immediately, and then the liability side pressure coming through. Now, if you see, FY23 was actually slightly, maybe even unnaturally higher. Now, I'm talking about banking sector as a whole, right? So within that, now the lag effect of the liability side repricing started to show up. It's not understood. Okay, so don't get me wrong. There was no negative surprise on that. In fact, in our sector, our sector analysts, when they wrote about the banks in this earnings, there not been any downgrades in that sense. We were a bit below street, but at the same point in time, there were not that many downgrades. What has effectively happened is that margin pressure has started to come through. What that is going to lead to is that I don't see that kind of abating for the next 2 to 3 quarters. The earnings will still be 18-20% for the banks as a whole. But at the same point in time, what will happen is that with these liability side issues coming to the fore, and the fact that now the probability of something on the rate side actually getting pushed out, is that this pressure will continue at least for the next 2 to 3 quarters. Now, within this, we believe that the larger banks are better placed, needless to say. But at the same point in time, at this big pressure point will continue to remain in the next 2 to 3 quarters.
2, 3 quarters, okay. So then, quick two-part follow-up to that, Unmesh. I'm guessing that, has that started getting baked into overall earnings estimates? Also tell us, for FY24, now that we're almost done with the season, where do you stand with respect to full-year earnings, given the fact that you're expecting this banking weakness to continue for the next 2, 3 quarters? And within banks, which are the ones that you would still back despite that expectation?
Okay, so as far as earnings are concerned, what's happened in this quarter is that we've seen some serious upgrades on the oil complex. Okay, so we usually look at earnings in 2 ways. One is the Nifty, which will also have the oil complex, and then the metals and all of that. And then we look at it outside of that, which is what I think is the standard street practice. If you look at earnings for FY24, we are looking at around, including the whole oil thing and all that, around 19 or 20%. 20, let's call it 20%. X of that, we'll be closer to 13-14%. That's where the gap is. Now, as far as banks are concerned, or for that matter, even our earnings estimate ex oil are concerned, we started the year at lower than the street. If you remember, the street numbers were between 16 and 18. I'm talking about the one where we are 14 at this point in time. And so we don't expect our numbers to come down as much. But what will happen is that we will see a little bit of catch up from that, maybe 0.5%, 1% per quarter types till the end of the year. So we will end the year at around 14% earnings growth. Incrementally, however, while anecdotally we've seen there are certain things on certain spots of bother as far as asset quality are concerned on the small ticket loans, but I don't think that is something which at this point in time is worrying us to the extent where it can become a systemic level problem. So from that perspective, I think banks should be broadly fine at this lower kind of level. Overall earnings, however, we believe, we've seen upgrades this quarter for the oil complex, as I said. Autos specifically driven by Tata Motors, and then some of the pharma names. But broadly, next 2 to 3 quarters, I think the ex-banks, the ones where the commodity consumer sectors basically are the ones which will benefit. Within the banks, your specific question, if you look at our model portfolio, it's around 60 bips higher on the banks and NBFCs, primarily driven by the likes of, we obviously can't comment on our own group companies, so that leaves out large part of it. But ICICI Bank, SBI and Axis being our largest overweights. Amongst the smaller ones, City Union Bank and Bandhan Bank. What you will notice is that most of what I'm talking about are banks rather than NBFCs and other financials.
Sure. Got that, Unmesh. Thanks very much. Good chatting about this, and maybe NBFCs for another conversation. Thanks for joining in. Well, that's the HDFC view on markets, earnings, and the big story, why bank stocks are falling. We'll take a break. On the other side,